Hey everyone, welcome back to my channel. Today I have a special video, and it's actually a first for this channel. I have Jason DeLorenzo, also known as Wizard of Ops on Twitter, who is the creator of Vol.land and understands dealer positioning like no other. Today we're going to ask him about dealer positioning, in particular Vanna and Gamma, on top of some other assets, as well as SPX and SPY. So Jason, thanks so much for jumping on the channel, and I figured we might as well just get right into it and start talking about Tesla since it has its earnings coming up. Jason's actually driving this for us today, and he's going to help talk about some misconceptions around Vanna, get into Gamma and how we can read these things to potentially structure spreads and whatever else. So I guess we should just get right into it here. First of all, do you want to say, hey, Jason?
Sure. Kevin, thanks for having me on.
Yeah, thank you. Yeah, if you could do me a favor and just zoom in on that Tesla chart and looking at price,
Sure.
so I have it as 118.85 as our current price.
Yeah.
Okay, cool. So this is one thing I wanted to talk about, and I think it's worth mentioning first to those that are newer to Vol.land or considering getting Vol.land is the when you're looking at the data, you should, especially if it's in the after hours like it is right now, you want to make sure you base it on the closing price of the asset. The pre-market and after hours data does not apply, and currently the data updates at 5:30 p.m. Eastern. So right now, we have the most up-to-date data on Tesla, and that is as of January 10th, 9:48 p.m. Eastern. And so one thing I want to talk about here, and this is actually a misconception. I've probably gone over, I don't know how many times have we talked about Vanna in depth. I've probably gone over it. This would be time number 3. But so initially I was under, I knew that positive Gamma, or excuse me, positive Vanna above spot price would act as a magnet. But I was under the impression that negative Vanna below spot price, and again, these are based on IV fluctuations, which I'll love to have you explain to everyone because it's something that you can do better than anyone else. But so I had some of the impression that negative Vanna below spot price could also act as a magnet, and you recently corrected me on that with positive Vanna, whether it's above or below, actually has that magnet effect.
Right.
And then,
Yes.
okay. So yeah, what could you elaborate on that before we get into it?
Sure. So first thing we have to clarify, because when it comes to something like gamma, it is extremely easy to understand because it's, for all intents and purposes, two-dimensional. It is just whatever the strike is and whatever the price is. And if the price is approaching it, you know that the gamma is going to get higher for a long option, and you know it's going to get more negative for a short option. And that's easy because gamma is actually related to the underlying movement. Vanna is not related. So it's almost kind of like 3D chess when you're looking at Vanna, because implied volatility, while correlated with the underlying, is not it is not the guaranteed to move in a certain way when the underlying moves a certain way. So the impact is a little bit more obtuse than gamma. So it is difficult to understand. So Kevin, I'm sure all the options aficionados and everybody will forgive you, including me, for making that kind of mistake. It is tough. But here's kind of the way to think about it when it comes to dealer hedging on Vanna is, first of all, the underlying and implied volatility have an inverse relationship. And you can kind of think of it when, the most popular is VIX goes negative when SPX goes positive, right? Does that make sense, Kevin?
Yep.
All right. That normally happens. And when the market comes down, usually VIX goes up. So there's an inverse relationship there to think about. Excuse me. Now, when I say that a positive Vanna strike is a magnet in Vol.land, and remember, Vol.land is the dealer positioning, it's not the customer positioning. So when the, say here in Tesla, let's just for now, let's pretend that the market Tesla is sitting here at 106 and it's dropping to 99. Typically, the Tesla implied volatility would be going up as the spot is going down.
Mm-hmm.
So that's kind of a prerequisite to the whole magnet and repellent thing. As it's going down, positive Vanna means that as implied volatility is going up, deltas are going up. So positive means they're going in the same direction. As deltas go up, in order to hedge, dealers must sell. Right?
Yep.
So therefore, when dealers are selling into the positive Vanna, then it creates a feedback loop down to that strike, which would be 100 right here.
And that causes that magnet effect. And so this is assuming that it's the standard correlation we see between price movement and IV, where price is moving down, IV is moving up, price is moving up, IV is moving down, basically.
Right. Yeah. And yeah, I don't want to overcomplicate things either, but
sure,
that it honestly means that all of the strikes will have implied volatility changes. So it's not really guaranteed that it's going to act as a complete magnet if all of the strikes start altering their implied volatilities. But typically, because that effect will intensify the closer you get to a point, it will typically act as a magnet. And especially when you're on the strike, it will kind of act as the sun and price will be the planet.
Sure. And just quick question. So that strike that we're talking about, that positive Vanna strike at the 100 strike, is that when we're talking about IV shifting up and down, are we focused mainly on that contract itself or those contracts itself, or are we thinking about it as IV as a whole across all the contracts, sort of like the way VIX would work with SPX or SPY?
So when you're talking about this strike in particular, the one I just circled, it is the implied volatility change on that strike. Now, because Vol.land is kind of making a little bit of assumptions on the summary sheet over here, this will just have an assumption of total VIX. So this is the current Tesla quote unquote VIX. 85. Can you imagine VIX being 85 on SPX? Sure. Yeah. And it being normal? Right. But this is the VIX. So we kind of make an assumption since VIX does account for all contracts. But again, skew would play a part, and there would be other things that would play a part into that. But it is a reasonable assumption at this point in when measuring Vanna effects.
Got it. Okay. Yeah, and that makes sense. I totally understand the IV assumptions have to be made because of how they fluctuate across the chains. But so that would be but when we're talking about price moving down, IV moving up, creating that magnet around that strike you circled, in particular, we're concerned about the IV movements on that strike.
That's right.
Okay.
Yes.
Okay. Cool. And then also, I just had to check real quick. The last time VIX was at 85 was on it was COVID, March 23, 2020. Yeah, which makes sense.
That was the last time SPY was moving like Tesla.
Right. Yeah. Exactly. Okay. Cool. So that's very helpful. And then just to make sure I understand the other side of it, so when we have positive Vanna above spot, for that to create the magnet effect above spot, we need IV dropping. So price moving up, IV dropping.
That's correct.
Yep. Okay. Yep. Cool.
Right on. And I noticed that in your tweets that you started to emphasize the cumulative chart on Vanna.
Yeah. Yep.
And what this is giving you is right here and year at the extremes, if you add them together and they are very positive, then you can expect the just smaller implied volatility movements to create a larger effect in the price.
Sure.
Kind of like we've been seeing nowadays in SPX. Normally, smaller VIX movements have created a lot wilder moves in price, and that is caused by a strong Vanna, by strong net Vanna presence positive. Now, the other thing too is when we were talking about positive strikes being magnets and negative strikes being repellents in Vanna, you can also apply that to the cumulative. So we're sitting here at 118 right here. You can see now that it's strongly positive over here and almost neutral over here. You would think that when implied volatility moves, it would trend stronger to the downside than it would to the upside, whichever side is stronger positive.
Okay. Interesting.
And that's just, again, there's a bunch of assumptions that go into that.
Sure.
Essentially, that skew stays the same. And implied volatility goes up in a uniform fashion, that kind of stuff. But in general, I would, when I look at this Vanna chart, I would say, oh, it's time to lean bearish or, be ready for bearish things. I wouldn't necessarily say, okay, Tesla's going to 100. That's not what I'm trying to say. But Tesla is kind of leaning down a little bit.
Right. Got it. Okay. Yeah, and I mean, if for anyone that has Vol.land or is looking at my morning Twitter posts or anything like that, that's why I started including the cumulative chart, just for my own sanity as well when we're talking about Vanna, to get that general idea of impact. And that's what's nice about it, is you can see based on that cumulative chart on the right if we would expect buying or selling as that strike is approached. And so taking right now, looking at Tesla's Vanna chart, and so you have the star marked at the current price, right, on the left side. So it looks like, we're essentially between these positive Vanna strikes, these magnets, really.
Absolutely. I think so. When I'm looking at Tesla, and I'll go through kind of how I do it. The first thing I look at is dealer adjusted gamma, just because I want to see what, how are dealers positioned. And here at the strike, we see a small positive, but here at 120, we're looking at a pretty large wall here. It's going to be very tough to get over this hump.
Right.
And when you look at Vanna, now I'll look at Vanna, and you'll see it's a lot of positive stuff here. So if I'm on Tesla, it's a lot of magnetism right in this zone right here. I would be probably thinking short gamma until we get to these strikes over here.
And can you just elaborate for viewers
like
as well?
A butterfly or a condor or something like that.
Right. So
essentially
a spread where you're selling the sides, basically, or for like a condor, you would wrap the sides in credit spreads, right. Essentially. Yeah. Okay.
Right. And the reason why I would do that is so we're going to create kind of a magnet here, and implied volatility is at 85. We're just kind of in the upper range of where Tesla is, and which makes sense. Dropped 70% last year.
Yep.
But if I can make a condor that would essentially profit in this zone, and I accept the risk of these zones where this side will be repelling right here, and this side would be attracting right here.
Mm-hmm.
So we kind of have a wall here. Maybe I might adjust the condor a little bit to kind of maybe go over here, something like this.
or even maybe
right? Because remember DAG, in the DAG curve, we kind of had some red right here too, right?
We had that big wall. Oh, and just so people who don't know, because I usually just show regular gamma. What delta adjusted gamma does is really nice. Is you're not that familiar with regular gamma, it just shows with the way the bars are structured. If they're negative, it means dealer selling. If they're positive, it means dealer buying, based on the current spot price. And so and so in this case too, I guess because we have that big wall above us, that big gamma wall you showed. That DAG showed it as negative, but I'm assuming that's just a big positive gamma strike there. What would you consider like a broken wing butterfly there as well?
Yeah, broken wing butterfly. I mean, yeah, any of that would be effective.
And could you talk about how you would base the expirations on that as well?
Sure. Essentially, I mean, so we saw that big gamma wall. The question is, when is it? So I would go over here, I deselect everything, and let's wait until we see the big gamma. Oh, there it is, 120. That's 140 million, negative 140 million. Yeah, so it looks like 120. It looks like the monthly expiration is when that is. Gotcha. So if I'm positioning something, that's what I would start looking at. Now, you were telling me that Tesla earnings are on 127 or 125, right?
Yep.
So this is the first expiration after gamma earnings. So let's see what we're looking at here. Nothing much, I guess. 8 million. Now might be a good time to put on something for Tesla earnings because, I mean, 8 million in gamma is the notional trading every day on Tesla is 34.1 billion. That's shown here in this chart. Takes a little, yeah. So I guess we got like 34 billion here in today's equity notional, right there.
Yep.
So 8 million to 34 billion is pretty small. It might be a good time. It might be a good time to maybe buy a straddle or something, preparing for earnings if Tesla earnings move things. I'm not tracking Tesla earnings very much, but that's just something to think about when you're looking at this.
And yeah, that's a great point. And then also just thinking about earnings. When earnings happens, and of course we get the IV crush that any new options trader has experienced losing money to if they bought a call or put into earnings. So when that IV crush happens and we see IV rapidly falling off after earnings, does that typically create, just naturally in the way IV is moving, does that create a draw towards positive Vanna magnets then that are above spot? Or
so you kind of have to think about it here. So if we're looking at Vanna, and I'm just going to pretend, because it's not the case, but I'm going to pretend that, actually, you know what? No, I'm not going to pretend. I'm going to actually look at this. Let's say not another option gets bought to hedge Tesla earnings. All right. Not a very great assumption, but when you see that the net Vanna is positive on both sides, even both positive and negative, that means on the upside and downside, that means that as IV comes down, and when IV comes down after earnings, it comes down on the whole option chain.
Yep.
So when it has positive Vanna like this, and IV comes down hard, then deltas come down, which symbolize buying. So dealers are going to have a buying bias after earnings. Now, earnings can blow them up, but the way the dealers are positioned, they are going to be buying after earnings.
Right. Yep. Yeah. And so anyone watching, like, this doesn't mean go buy calls, obviously, because one, you have the IV crushing your options, and two, as Jay just said, we have, you don't know if their earnings is going to bomb or whatever, and the thing just tanks. But we do know that dealers will have to do a lot of buying, which can help drive our decisions around spreads.
Yeah.
Interesting. Yeah, that's really enlightening. And it's super helpful, especially with adding in the expirations there. Could Could we jump over, unless there's anything else you wanted to point out on Tesla here? Would you mind if
I mean, I could do a quick, yeah, like I said, Tesla right now, just to wrap it up a little bit, the price is right in here, right here.
Mhm.
And because of all the positive Vanna around here, I'd be looking to be a net seller of options. That's kind of how I trade. If you are a future, you just click buy and sell the stock. I would be bearish lean on it, but I would not, I would take profits as soon as I can when I see some kind of trend line or whatever technical analysis that Kevin guides you to. I would lean down, lean bearish, and not expect as large moves as Tesla is used to giving. At least not until implied volatility.
Makes sense. Awesome. All right, cool. Yeah, so then we have, let me see which one's happening first here. So we have Amazon happening on February 2nd. Yep. And Apple on, yeah, let's do Amazon then. We're sort of in this, and that's what I'm hoping we can talk about as well, is getting into this period of time with CPI coming up and this range we've been pinned in. And yeah, so Amazon is 89.87 right now.
When I look at Amazon, my first thought is this 90. So it is, people are buying puts, and therefore now dealers are short puts here on 90, huh?
So in the way, just so we can back up here, the way you derive that dealers
are
short. Sorry, no problem. I just want to make sure, because a lot of people aren't as well versed in it. So you see when you pulled that up with the deltas, and you saw positive put notational hedge requirements, positive delta exposure at the $90 strike. Yes. That means that dealers are short puts, which means institutions are long puts, meaning institutions have bought puts.
Yes, institutions are hedging at 90. Now, I had to make sure it was bought puts because institutions can also sell calls and create a positive delta. Right. But that's not the case. The puts was a pretty large spike here. This spike right here at 105 on delta that isn't showing up here is likely because that is very far out of the money. So somebody probably bought puts at 105 for a distant expiration. So it shows up on delta, but doesn't show up on gamma.
Interesting. Okay, I was wondering that because I didn't notice that sometimes, and that's just based on how far out the expiration is. There's not a lot of gamma hedging requirements there.
Right, gamma and Vanna have less of an effect the further out you are, or the further out the expiration is. But delta has more of an effect. So, I mean, if you, if you're buying like 60 delta, or I guess in that case 60 delta, 70 delta puts, the gamma is not going to be there, but it's going to show up as very large put.
Right, and there is when that occurs. Correct me if I'm wrong, but there is an immediate hedging impact that occurs from that, just based on the deltas. And then, of course, we have the dynamic hedging from gamma and Vanna, which is less impactful because of the expiration.
That's exactly right. Yeah.
Okay.
Yeah.
All right. Cool. Yeah. So same sort of thing here. So we have a lot of dealer buying at 90 right now at the $90 strike.
Well, yeah, but we're kind of sitting on top of that strike. I think what's the price, like 89.99 or something like that.
Oh yeah, sorry. So we're right under it. Yeah.
Okay. Yeah, you can look at regular gamma to kind of see what exactly we are.
Sure.
And since it's strong negative gamma here, you can expect probably stronger movement one way or the other. Right. So yeah. I mean that.
And sorry, not to cut you off. Just to talk about that with negative gamma, and gamma is much easier than Vanna, but negative gamma has its biggest impact when we're actually on the strike. So basically, as we approach the strike, so say if we see price moving up into the $90 strike, as we get close to it, we'll get buying. We'll see dealers buying. Dealers will do their most buying when we're directly on the strike, when we're directly on $90. And then as we pass over it, that buying will essentially slow down, creating that acceleration effect as it gets passed through. And it's the opposite for positive gamma, where dealers are actually would if this were positive gamma, they would be selling against that move higher.
That's right. Yeah, you can almost look at gamma as support and resistance when it's positive. When it's negative, I don't know what you call it, permissive. I mean,
Sure.
And you know, short options are negative gamma, long options are positive gamma. And we kind of saw when we did that whole delta routine before, the dealers are short put. It's right there at 90.
Mm-hmm.
When you talk about like the JECs that, you know, spot gamma or what squeeze metrics used to talk about, or even, you know, tradie ticks, what they do, they have a confluence of all of the put OI, which they assume is bought by institutions and sold by the dealers, and all of the call OI, which is they assume is sold by institutions and bought by dealers, and they have that like 1 point of that JEX where it's just, you know, where it equals 0 when everybody says, oh, that 0 JEX means increased volatility. While I, you know, basically categorically reject the assumption of all puts are bought and all calls are sold.
Right.
Their assessment, though, of negative to 0 gamma being increased volatility is correct. So when you do see large negative gamma strikes like this, you would expect Amazon to move one way or the other.
Right. Yep. Just by nature of all the buying and selling that has to occur as we approach it, creates that excess volatility. And okay, cool. So we know that.
So I do want to bring something up, though. Amazon now is at 89.99. We saw gamma is negative. We saw delta was positive. What do you think Vanna would be? Before I click it, Kevin.
Oh, in this case, it should be negative. Right.
Should be negative? Is that what you think?
Oh, now I'm second guessing. Gamma's negative. It should be. I'm in my head now.
And where the price is right here, right on top of it.
You're putting me on the spot. Just click.
Yep, I'm putting you on the spot. Right there. This is where price is.
Oh, actually, okay. Wait, no, price should be under it, I thought.
Right, it's like right on top of it, right?
Okay.
What's the price right now? We'll check.
All right, well, in that case, if it's right on... I'm going to assume magnet effect, so we'll assume positive.
All right. The correct answer is...
Negative. Oh my gosh, you psyched me out.
Well, no, it's negative, but if you look at the y-axis, it is barely anything, and that is because at the 50 delta, Vanna is always nothing.
Oh,
and
right.
To think about it like this, right? Let's say it is 2 days to expiration, and you're right on top of the, you know, Amazon did not move, and you're at the 50 delta. 1 day to expiration.
Mm-hmm.
And are you going to end up on, you know, above or below the price? You don't know yet. You're still at 50 delta. And really, I mean, again, I kind of want to frame Vanna a little bit for the viewers. When, let's say you're long a call outside of the money. So let's say this over here is a long call, okay? And that is like, say, 30 delta or something. As implied volatility comes down, or as time goes on, charm, right? They both kind of have the same effect because they're both on the premium. The delta goes from 30 down to 20, down to 10 as that second day to expiration, 1 day to expiration. The chance of reaching that strike goes down. Mm-hmm. So it's like 30 delta, 20 delta. It trends towards 0. However, if you're in the money call, like say a 70 delta, the delta actually trends up. It goes from 70 to 80 to 90. And at expiration, all deltas are at 100 when they're in the money.
Okay.
Right?
Yep.
Does that make sense?
Yeah. Yep.
So when you're at 50, you don't know whether it's going to hit 0 or 100. It's kind of a maybe. So Vanna kind of, I mean, I'll use this as an example, but the way Vanna is on a long, if price is down here at 0, right? Vanna will be positive. That star is where the price is. And it goes like this.
Right. Yep.
That's kind of, so anything below down here, a long option would be positive Vanna right here, because again, say it's an in the money call, it's trending up toward 100. And out of the money put long is trending from negative 30 to 0.
Right.
So
okay.
that's also trending up. So that's just kind of how to conceptualize Vanna in your head.
Yeah.
And then at 50, you don't know, but then it reverses down here. So, I mean, this is just trying to conceptually, I'm using Amazon as an example.
And that's a great point. So, and especially based on what you were just drawing there on the impact. So, Gamma is having its biggest impact on the strike. Vanna is having essentially no impact on the strike, right? So it's
exactly right. It's the least impact. Implied volatility is the least impact on the 50 delta strike.
Okay. And then so as we move away from that, whether it be above or below, then we start seeing that and well, not just the movement itself, I imagine, but also the IV has to factor in here as well.
Right.
But so, assuming it's moving down, we see IV going up. And you had mentioned before, Vanna has its biggest impact when the delta is either roughly 0.2 to 0.3 versus or 0.7 to 0.8 on.
Yeah, it's like 0.2 to 0.4, give or take.
Okay.
But yeah, it's in that range, and then once it gets up to that 0.4 area, then you start seeing Vanna having a diminishing impact as it gets there.
Right. Yeah.
So here, though, like, if we're looking at Amazon right now, Vanna has very little impact. It is going to be, I guess it'll be negative. I mean, it's just kind of is what it is right now. It's close to 0. And so right now you're looking at Delta, or I'm sorry, not Delta, Gamma as your largest driver.
Right.
Vanna. Now, another thing to also about Vanna. Vanna is the implied volatility's impact on Delta, and that effect gets hedged through swaps, and in SPX it'll be VX futures. There's lots of swaps on even individual equities, and that's kind of how dealers hedge for implied volatility, and about like an 85% clip or so. That's what I assume. But if you want to even assume 90%, that means that this is only 8 million in Vanna. So let's take a look at Gamma, and you'll see it's a lot bigger impact, closer to 16. So it's double the impact right now on Gamma.
Yeah, and that's important to note, looking at that y-axis just to make sure and then going back to the summary page, you can actually compare that to how much was actually spent on, and this is based on so yesterday's, or it's today's trading session, but the trading session that just happened, that underlying equity notational dollar volume is going to be how much was spent on Amazon as a whole this past trading session, correct?
Yeah, and it'll be right here. Right now it's loading because our feed is kind of off, but
yeah, yep, that's okay.
Yeah, this is after market hours, but right here, and I wrote it down. It's 21.6 billion was traded in Amazon this session. So 16 million versus 21 billion. It's not going to be that much of an impact.
Okay.
But
and so that,
yeah, I mean,
so that's kind of been a common theme I've been noticing, is that it feels like in this particular, like right now where things stand, right, we have earnings coming up, we have CPI coming up. It's January, the first month of the year, and it even was kind of like this in late December. But if it seems like that a lot of the dealer positioning impact has been smaller than it was in prior months. Is that the case, or am I just kind of imagining that? Because
So I think that I mean, it depends on obviously on a stock by stock basis, and I don't track Amazon on a daily basis. Um, I mean, if you're looking at the summary sheet, it it has been a little bit smaller, but mainly because realized volatility for the past 3 weeks, we've been stuck in a range,
right,
and um, once you start getting hedged in that range, and you just keep going back and forth, you're not going to hedge much more.
right,
Um,
right,
you can't. You're not going to hedge every single tick. Um, and when it comes to Amazon, by the way, this y-axis, the 16 million, is per point in Amazon, and Vanna is per implied volatility point. So that's something that's
oh, okay.
Amazon.
I didn't realize that.
Yeah,
Okay,
and so Amazon's it's harder to move implied volatility obviously than it is to move uh, the actual underlying 1 point. Um, but
okay,
yeah, so I mean, has dealer hedging had more of an impact? I mean, in SPX, it has had an impact, and I guess we'll get to that stock later. But it has had an impact, just not the normal impact. And once you start trading in a range for a while, you don't really need to hedge so much anymore.
that makes sense.
So
Okay,
yeah, so I mean, that's kind of it's had. So the answer is yes, it's had an impact, but not in a traditional. The dealers have to buy a lot or sell a lot in order to hedge. It's more that they have set their boundaries, and the market has not made them do anything.
interesting. Yeah, and I mean that makes perfect sense, really. Now, so on that note, I mean, I was gonna we're about 37 minutes in here, so maybe we could just jump right over to SPY and SPX and get your take on
Sure.
CPI.
Yeah, sure. Sorry,
Oh, no,
I get
I don't.
long-winded. Well, now that we've had the background too, it's probably a lot easier to talk
Sure.
about SPX. But
Yeah.
so I'll go really quick. First, looking at delta adjusted gamma, we're looking at a lot of negative gamma here, and you're gonna have to take my word for it because I've done a lot of staring at SPX for a while now.
Sure.
We are currently what 39.20 or something, so
Yeah. I'm checking the exact price
right
right
around
now.
here,
Yep, you got it.
right?
39.1925.
So
Yeah.
so in this area, you can see buying here, and you're not quite going to see it here, but I guess it's a lot of selling right here
Mm-hmm.
in gamma. But in SPX, Vanna is the winner. They are the leader in the clubhouse. So let's go Vanna. You can look over here. It's 30 billion, 40 billion. So this is
Yep. Yep.
this is the area that you kind of want to look at. And even if it's 10%, that's 4 billion per VIX point, right?
Right. Right.
So um so this is the primary driver. Um you can see that there is a little bit of attraction here, and you're not going to quite see it so clearly, I guess, now because it's a little bit, but there's a January strike right here and a January strike right here that is all negative Vanna. And as time has gone on, we have been, I've been calling it Pong. It's almost like you could see these two Pong paddles right here and right here. And there's the little dot going bloop, bloop,
Yep.
bloop, right? Bloop. And it's going back and forth. And if you look at the range that we've had on SPX recently, it's been down to 3,800, 3,750, up to 3,950. And this is the range in which Gamma or Vanna would have its largest impact. So you're kind of seeing that stuck right in here, right in that
Yep.
range.
Absolutely.
When you look at CPI, I mean, the overwhelming expectation from, my Twitter and, even the past several CPI readings is that it will be lower than expected. And when it is lower than expected, it tends to, the market tends to go up. Well, the macro people tend to push it up.
Yep.
We're looking right here at this negative Vanna at 4,000. If we were able to push up above 4,000, which we're only 80 points away for SPX, then we're looking at a pretty large magnet here. This is also in January, a pretty large magnet for the rest of the OPEX. We'll probably just surround in this area, and these negative Vanna will keep us from ever getting above here. So if we get to the 4,100, and this one also flips to positive, you can probably start selling call spreads right here.
So it's funny too, because I know you don't necessarily use the chart, but you can see clearly, like when you, and this is what always fascinates me about with this. I actually made a post about this evening, but talking about how, like, we've been in this bear market, and there's been a specific trend line that you can draw from the start of the bear market to now that's been respected perfectly almost every time, except very recently, where we had 2 points where 4,100 was tested and then we had a strong rejection from. And so there's a lot of buy stops resting up there, right? And so there's a lot of buy side liquidity in the form of buy stops. And so my personal expectation is, and I hate putting this out here because I'm not a licensed, I'm not licensed to give advice on like stock plays and stuff like this. Just talking about how I personally am viewing this based on CPI coming in cooler. So I fully expect, as you just mentioned, we get past 4,000, we magnet to 4,100, go a bit above, clear out all those buy stops, matching, potential sellers to buyers there. Just wiping that board essentially, and then just plummeting from there. And as you just mentioned, looking at 4150 negative Vanna above and 4175 above, and those sort of confirm that theory. And that's why I love pairing this dealer positioning, because it happens so often like that, where if you're just looking at, and I'm not talking about technical analysis like from the traditional perspective, where you're drawing shapes and triangles and heads and shoulders or whatever, but just like looking at a chart to see where the potential liquidity lies, and in areas that will likely be targeted by institutions. And more often than not, it lines up perfectly with like what we're showing here, and it's just fascinating to me. But
I always kind of say technical analysis isn't useless, but a lot of times it's picking up something real in the market. And personally, I feel more comfortable knowing what the real thing is.
yeah,
But
yep.
but I mean, I guess it's not that much of a prerequisite. But yeah, I mean, 4,100. If CPI comes in, nice and gentle, 4,100 is a really good target. If it comes in hot, or the market doesn't like whatever they see, we can possibly see a drop down. Depending on whether we can break 3,700 negative Vanna right here. If we drop that, we have this. If anybody follows me on Twitter, at WizardOps, I did the whole Tatooine with the two suns and Luke Skywalker looking at
I saw
the two
that.
suns.
Yep.
These are our two suns.
Right.
And we can probably have like a binary sun situation orbiting 3,650, 3,600 for a long time, because those are out until March. And that's pretty strong Vanna magnets way out there. So
as you mentioned, basically the prerequisite to that would basically be CPI comes in hot. We get past that negative Vanna level. Those two positive Vanna towers, essentially those two suns, become magnets that suck us right into it. But essentially, because price is dropping, IV's rising, blast past that well, it looks like two we'd have to get. So at this point we'd have to get past some negative Vanna at 3,800, and then negative Vanna at 3,700.
Yeah.
And then we just get
the
stuck.
3,700 has had quite a bit of an impact, over these past several weeks, and but then all of these up here, I'll undo my pictures. Everything here, including this strike right here, these strikes right here, and this one right here, which I've been really wanting to sell a call spread against, but the opportunity never really presented. It's kept, we've been too far away from it for a while.
Sure.
All of that expires in January, and this expires in March. Kind of have to take my word for it for now. But,
that's really interesting. That's
so overall, I mean, personally, I have a long gamma. Here, I'll draw what that looks like. I have like a long gamma call or put spread right there, assuming we are destined to hit that 3,650, 3,600 area, probably a little bit lower even, at some point in time. And so I have a spread there for March.
Yeah, and one thing I want to mention too for people considering using Vol.land, it does have a Discord, and Jay does educate people constantly on this stuff. He's the best source to get it from, and you even post your positions, correct? Like what you're actively.
Well, I post where I lean. My positions I reserve for subs. We have a private sub there, and the actual positions, I revealed one here, but yeah, my actual positions I leave for that channel, but it's
right.
I give enough hints.
Yeah, but if you're a subscriber to Vol.land, right? Yeah, which is pretty fair. Yeah, I didn't even realize you could join it for free. So
you can join the public, and I talk more on the general chat than I do on the sub chat. I mean, mostly it's about educating and telling people where I see the strikes and where actual trades are a little bit different story,
Of course.
Yeah. But yeah, I mean, people ask me, the other thing too is I have a script that, for now that I have 0 data expiration option traffic on, and there's so much traffic, particularly in SPX on 0 data expiration options, and it's amazing how often the strong long Vanna strikes get hit on the 0 data expiration options. It's
interesting.
It's pretty incredible. And I keep people abreast in the general channel, like, oh, my script is saying, we're gonna head up or head down, and I give some strike targets. And typically, but back in the old days of Twitter, when I used to go on, when Twitter was my primary and not Discord, I used to do the bold calls, hey, we're going to bounce 30 points here, 40 points here. And that's kind of when I started getting my followers, is when those started hitting. And it wasn't really guesses. It was based on this 0 data expiration and some dealer stuff. I didn't have Vol.land back then, but now my bold calls have been better because I had Vol.land. So
yeah, that's amazing. So on that topic of 0 DTEs, and this is one thing I'd been thinking about, and I wanted to ask you this for a while actually, and I just now remembered. So when this is the first time in history where we've had 0 DTE options on SPX, SPY, and QQQ. So now there's sort of like an insta hedging mechanic, if you will, where you don't need to buy a ton of, you don't need to put buy options that are a month out in order to hedge large positions. And so if you're long and you're buying puts to hedge your portfolio, you can do them same day if you start seeing a massive drop. And then of course if you do that, or if big money does that, enough of that, then those 0 DTEs expire off, and there's that de-hedging impact as that happens. Do you think that because of this nuance that's like pretty new in terms of the markets, right? Like when we think about past bear markets or even past recessions, if we do truly enter a recession based on how you define recession, Do you think that like that will actually cause a lot more of those like rubber band rallies at like on like a random day, like pick like a random
Yeah.
Wednesday or random
So
Thursday.
right. So there are a few things about zero data expiration options that make them unique from the rest of the option chain. The first is it is cheap gamma, and by that I mean you don't have to pay a lot in order to buy, say, a 30 delta put or call
Yep.
because they're cheap. They're about to expire.
Right.
Um, that's the first thing to note. And I kind of, I mean, this is completely speculation, but I kind of think that at times, I think that dealers are the ones that are buying some of these zero data expiration options in order to hedge their positioning um,
Interesting.
against intraday moves. The second thing to note is that there there are no clearinghouses that um, that recalculate margin requirements intraday. It's too much of an effort.
Hmm.
So because of that, you're able to buy and sell round trip zero data expiration options without having to deal with the margin requirements inside of
Interesting.
institutions. And I have a feeling that there are some institutions that are taking advantage of this.
Sure.
So um, that dynamic, I think, can make such an exasperating drop or even rise. I mean, it could go either way um, because there will be a lot of risk that clearinghouses do not realize that they have. Um, Now, based on the script that I was talking about before, it is my judgment that institutions are buying puts and selling calls. So it's like that standard JEX look in zero data expiration. So if that cascading drop were to happen and clearinghouses get caught off sides because they don't realize that they were in more risk than they were,
Mm-hmm.
I have a feeling it would be to the downside. And so, because that's where all the gamma is, it's all down, right? Um, so when that would happen, I don't know. It may happen at a time where there's like a some kind of uh, unforeseen event in the middle of the day,
Right.
and everybody's positioned, and it's unforeseen. So how am I supposed to know when it's going to happen? You don't know when it's going to happen.
Yep.
Um,
Just a
so
black
that's kind
swan
of
event in the middle of the day.
right. So
China
if
declares
something
war.
happens, right, China, all of a sudden China's flying planes over Taiwan, and it's only 1 o'clock here. Um, we're you're probably not only going to see a market meltdown, but then it's going to double meltdown the next day when clearinghouses start calling up people and saying, "Hey, you need to give us some money." And there's going to be a bunch of zero data expiration bankruptcies out there.
Wow.
So yes, I think zero data expiration poses a danger. Um, they it I it is standard, put buying, call selling, kind of um, formation, I guess you could say, or what people are doing. Um, and it is, and it is fascinating. I do think some of it is dealers hedging um, their Greeks in a cheap way, and yeah, but you don't want to be caught off sides on these zero data expirations. You can lose a lot of money really
Sure.
fast.
Yeah, absolutely. Yeah, very
So,
interesting. That's yeah, I mean it's such a new thing. I mean I guess at some point, right, they should be making an effort to be able to calculate those margin requirements on the fly. With this becoming a thing, like I hopefully it doesn't stay that way until there's a major incident that you were just
well,
referring
yeah,
to.
exactly. I was about to say, uh, as a like it's probably something on the risk radar that until something happens, nobody's gonna, why spend extra money on something that didn't break
Yeah.
yet, like
Yeah. Yeah, as the words
but
left my mouth, that's what. Yeah.
so
That's crazy. Um, well, yeah, so I guess one final question. How, when you look at SPY in comparison, right? Because I have noticed, and today was a really good example of that. Like we had some positive gamma on SPY. It wasn't anything crazy, but the way that SPY bounced off of 390, it seemed like it was really applicable. Right, we went, and I'm talking about the New York Open, right? Because that's when I usually try to get the bulk of my trading done is from 9:30 a.m. or sometimes 8:30 a.m. because I do futures to 11 a.m. and I'll keep tabs on SPX SPY, the notable Gamma, Vanna, things that I call out on the Twitter, as well as watching the futures charts and trying to gauge where market makers want to take things. But so it was a really clean bounce. I mean, to the point basically. I'm trying to find it here. Yeah, to the tick. I mean, to the cent. Right, we had this bounce off a positive gamma level at 390 on SPY at 10:15 a.m. today. Um, and I particularly called that level out on 390. And I was just curious, like how much do you give, like comparing SPX to SPY, how much weight do you give it, right? Like is it hedged differently? Should we be looking at both? Is it helpful to look at both? Like what's your take on that?
so something you won't see in Vol.land necessarily, but the notional option volume in SPX is 5 times that of SPY.
Mm-hmm.
Okay, that's so essentially SPX will have 5 times the weight of SPY. That being said, though, really after that, the scales are all right over here on this y-axis. Here I'm looking at gamma, just strictly gamma, 80 million in SPY, and you can make your calculations, and then we look at SPX gamma, and you got like 40 million,
Sure.
100 million right here. And also you have to note though that SPY is a tenth of SPX.
Right.
So if you're going to equate them, you have to multiply SPX times 10,
Right.
like on the y-axis. So SPX really kind of has a larger impact on the underlying. I would say that they're hedged kind of similarly. SPY probably has more of an underlying hedge component to it, but the institutions mostly use SPX, and SPX is hedged by ES.
Mm-hmm. And
Futures?
is SPY hedged using shares on SPI underlying?
Probably, yeah.
Okay.
Yeah, because that also, because the shares have implicitly included all the dividends and risk-free rates that the SPX doesn't have. SPX doesn't have dividends.
Yeah. Right.
So SPY has that all embedded into it already. So I think SPY is more or less hedged with actual ETF shares.
Sure.
And SPX is done by ES and VX futures.
Right. Got it. But so it is certainly worth taking a look at, though. Like,
oh, absolutely,
okay.
And especially, I mean, it is a tenth of SPX, but 10% is 10% of a lot is a lot.
Sure.
So yeah, it's not as clearly defined levels in SPY, it seems. So when I'm looking at SPY, I see kind of a lot of negative gamma right here. We could kind of, clean it up a little bit, but the net seems to be a lot of downside here.
Mm-hmm.
Or like, we're teetering here. And if we look at Vanna, Vanna seems to be having an exaggerated look at implied volatility. You can see it's also 500 million, 1 billion. If you remember back on SPX, it was like 80 billion,
Yes.
100 billion. So it's there, but I mean, you can also see that those twin towers are here too.
Yes, they are. Yeah, and I've noticed that even though the notational hedging requirement is lower, they are like they line up really well typically. It's not.
So I think that there is some like arb there and stuff like that.
Okay. Yeah, because I've just noticed way too often, where like on Twitter, I'll because I do both SPX and SPY, and I'll call out a specific gamma level, right? Like whether it be like 387 and 390, because those are like the largest positive gamma in that particular range based on where we closed at the day prior, and and sure enough, I mean it's to the cent, like, and it might go slightly over, but it's to the cent. We'll see like a rejection from, and as a day trader or scalper, I mean, it just seemed so valuable, and I just wanted to confirm that like it was definitely worth looking at. I mean, I was
saying,
yeah, yep.
Yep.
Okay, cool. Well, yeah, I mean, like I really, really appreciate this. Has been extremely helpful and eye-opening. I'm sure it will be for everyone that watches it too, and hopefully we can do another one at some point in the future if you have time, because I'm sure that people will want to see more and learn more, and
yeah, no, it's been fun. I'm glad I was able to come on and clarify Vanna and maybe educate a little bit on how to use Vol.land and how it helps trading. I mean, you're gonna end up doing Twitter posts all the time now with some good Vol.land analysis. So
yeah, yep, and when in doubt, I'll use the cumulative chart more. But no, that was extraordinarily helpful, and I appreciate it. And I could talk about this stuff with hours. There's a lot more I want to ask you, but we're at over an hour now, so I want to be respectful of your time and my wife. But yeah,
I gotta go to bed, man.
Yeah, absolutely. I will definitely talk to you soon, and I appreciate it.
All right, I'll catch you later, Kevin. Take it easy.
All right, you too.